the silver rally right now is driven not by speculation, but I would argue this systemic short squeeze, because you have record high lease rate. So it really means that London basically virtually has no free silver to meet rising investor demand and or back the billions of ounces in outstanding contracts. And with the lease rates at that level, it's basically the risk of a delivery default in London is rising. And that is the point where I do believe that what you just said is true, that there are traders that smell blood in the water with silver, and it is being pushed up because of the falling open interest, more by short squeezing than by anything else.
Andy Schectman, CEO of Miles Franklin, has issued a stark warning on the silver market, emphasizing that recent price surges are being driven less by speculation and more by a systemic short squeeze. According to Schectman, record-high lease rates, declining open interest, and massive delivery demands are creating significant stress in the market. London's silver market, which handles hundreds of millions of ounces daily, now has only a small fraction of freely available silver backing outstanding paper claims. This growing imbalance highlights the risk of delivery defaults and signals that physical silver is becoming increasingly scarce relative to demand. Schectman further notes that the U.S. government's designation of silver as a strategic mineral is transforming the market's dynamics. This classification establishes a de facto price floor, reflecting silver's critical role in industrial, technological, and national security applications. Corporations such as Tesla, alongside government stockpiles, are actively securing supply, intensifying competition for limited physical silver. Meanwhile, global powers like China have been acquiring and refining silver aggressively, even paying premiums for unrefined material, demonstrating a long-term strategy to secure this essential resource and strengthen their industrial and strategic position. Looking ahead, Schectman believes that these converging forces, industrial demand, government stockpiling, and strategic accumulation by global powers, will continue to exert upward pressure on silver prices. The market is approaching a pivotal point where physical demand could overwhelm supply, potentially triggering a historic revaluation. For investors, this means that silver is no longer just a commodity or investment vehicle. It has become a critical asset intertwined with industrial strategy, national security, and global financial positioning. Those who recognize this shift early may benefit from the structural changes reshaping the precious metals landscape. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think that is an incredibly intuitive question that you've asked.
Well, thank you.
So, yeah, because let's talk about that for a moment. Speculators, after months of little bit of liquidation in the gold market, where the speculators were taking profits and gold kind of just chopped sideways, they are returning with massive open interest rising again in the futures market. What open interest means is people are coming in to buy more open interest. They're buying more contracts, and prices breaking out again as we see it nearing 27 or 3,700. This is the normal link between purchasing and higher prices. Okay, to your point, and you're the first person who I've talked to in a while that's got, and that is that the silver rally right now is driven not by speculation, but I would argue this systemic short squeeze, because you have record high lease rates, you have falling open interest, meaning the speculators the hedge funds aren't buying. You have massive delivery demands, 58 million ounces since late August, 10,550 tons year to date. This points to a shrinking physical liquidity and mounting pressure on the market in London. London shows that they're trading 600 million ounces of silver a day, representing between 1 and 2 billion paper ounces claims 1 and 2 billion, and they have 140 million ounce free float backing that 1 to 2 billion claims and 600 million ounces a day. So it really means that London basically virtually has no free silver to meet rising investor demand and or back the billions of ounces in outstanding contracts. And with the lease rates at that level, it's basically the risk of a delivery default in London is rising. And that is the point where I do believe that what you just said is true, that there are traders that smell blood in the water with silver, and it is being pushed up because of the falling open interest, more by short squeezing than by anything else. And silver is something called a Giffen good, or Giffen good means that as prices rise, demand increases. That's kind of abnormal in investing, but it makes shortages even worse, because as the price rises, you'll get the industrials that say, man, we need to just jump on this now, like Tesla, because we need, so much silver and the price keeps going high. Let's just jump in.
Right. They got to lock it in as a hedge. Yeah.
Yes. And so, really, 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 really good question. And I would say gold's open interest is massive. That's the central bank. Silver open interest is falling a little bit, but the price keeps rising. That's a short. When you will see investor demand and industrial needs collide, the market will face, I think, that moment where there is a battle between the hedge funds and the industrial, which will massively add fuel to the fire, because the realization will be that that's exactly what is happening. And when you see the amount of silver coming in the first week of the September contract, as an example, we saw literally almost well over $2 billion worth of silver delivered into COMEX in just the first couple of days of this last week in the September contract. And again, what did I say? How much has come in so far this month? It was so far this month, the first week, because I didn't get the numbers yet for this week, 52 million ounces were delivered on COMEX of silver. So 52 times, your $2 billion right there. So that's just 1 week with 3 weeks worth of data left. This is every month. So someone or some entity with a whole heck of a lot of money is saying, yeah, we want the physical. We don't want your paper promises anymore for these reasons. Now, is it an industrial? Is it a government entity? Is it an invest? So is it someone that needs it, like Tesla or Panasonic or Sony or whatever? Or is it someone who says, you know what, we're going to stockpile this? See, the U.S. government got rid of its strategic stockpile ages ago, and they've always had to go into the open market to buy silver, even to make silver eagles. So I think it's a realization that in the end, it's about having the tools, as you mentioned, to further your society. China's realized that for a long time. They play the long game, and they've been buying this stuff stock, but they've been producing gold and silver even when it was uneconomical for years, using their trade imbalance, because they understand in the end, he who has not just the gold and silver, but all of the things. That's why China bought the LME, the London Metals Exchange, all the base metals. They own it, and they're warehousing these metals. They're building warehouses all throughout China that store the metals on the LME. That's why the whole premise of the Belt Road Initiative is partnering with countries that are resource rich and underdeveloped. We will develop your country. We will build the infrastructure. We get a piece of what comes out of the ground. And now we're making it so you can go back and forth on not only on transactions using the bridge technology, which is being rolled out to them, which settles in 7 seconds outside of the SWIFT at a 98% reduction in fees. You can settle in balances in gold, or you can take your gold that you pull out of the ground all throughout Africa. You can put it into a vault that will soon be in all of the countries around the Belt Road as collateral for renminbi-based loan, like a repo. And so we are getting to a point where gold and silver and commodities are becoming far more important than the paper that has been used to purchase them and to value them for a very long time. The folks in other parts of the world see this clearly. The insiders here, I think, now see it. When will that trickle down to you and I and the rest of us? Don't know. I mean, people watching your show probably have a better idea, but the people who we call friends and family, who are very well read and very intelligent, arguably just read the wrong stuff. And they are being misled and misdirected with the public, who's all in on margin, all in on leverage, on options, and all in stocks as the insiders go this way and gobble up physical assets. It's classic misdirection. It's the art of war. They're winning. Thank God someone in this administration, in my estimation anyway, clued in this President Trump and this administration to the importance of getting on the bandwagon.
Recent shifts in the precious metals market are drawing renewed attention, with Andy Schectman noting that the landscape has changed dramatically from past cycles. He argues that most of the public who wanted to sell their gold did so years ago, leaving today's market increasingly driven by institutional demand and central bank accumulation. The United States becoming a net importer of metals for the first time in history underscores this shift, as does the growing role of gold in new financial structures being built outside the traditional Western system. Initiatives such as gold-backed repo facilities linked to the Shanghai Metals Exchange, including one under development in Saudi Arabia, highlight how gold is being positioned as collateral in ways that could reshape global liquidity. Schectman underscores that while short-term fluctuations in gold and silver prices are inevitable, the long-term outlook for both metals remains firmly supported by strong fundamentals. He cites the U.S. government's designation of silver as a strategic mineral as a pivotal development, effectively establishing a price floor and reinforcing its enduring relevance as both an investment and an industrial necessity. This policy shift, combined with broader concerns over debt sustainability, currency debasement, and global economic uncertainty, highlights why precious metals continue to serve as critical assets for investors. Schectman further notes that mining equities can offer amplified exposure to these trends, often delivering outsized returns during bullish cycles, but cautions that their heightened volatility makes risk management and hedging strategies essential.
The United States being a net importer of metal has never happened. An administration who continues to drop clues and hints that gold and silver are certainly, whether it be reclassified as a strategic mineral or the comments, Trump, he who has the gold makes the rules, Besant being a self-proclaimed gold bug. We've talked about Judy Shelton, or Senator Lummis, all of the things about gold revaluation. The Federal Reserve just wrote a report on it. Everything that's happening with the BRICS, and this is something that should not be overlooked, and they are massively tied to gold. The fact that now the rumor about everything I was talking about with the expansion of the Shanghai Metals Exchange and the settling in gold outside of the trading and local currencies over Enbridge, they're now talking about, the rumor is they will have a gold-denominated repo facility that will be part of the Shanghai Metals Exchange, where you will take gold and use it as collateral with metal held in the Shanghai Metals Exchange and in the series of vaults that are now being built all around the Belt Road. The next one is being built right now in Saudi Arabia, which is very symbolic, but using it as a repo facility for renminbi-based loans, where, all of a sudden the Chinese and the Belt Road Initiative, who are trying to help build this ecosystem amongst all of these underdeveloped countries, will take gold as collateral for loan for repo. Repo is typically associated with giving liquidity to the worldwide market by exchanging treasuries for cash and then being able to buy them back at a later date at a higher price. If you can now switch that to gold, my point is that I truly believe we are just getting started. I truly believe with the passage of the Genius Act and the passage of a synthetic demand for U.S. treasuries, we have entered a new monetary system, and gold will be part of it. Silver will follow. Should you take profits? Sure, it's not a four-letter word. You certainly could. Would I personally? No, not yet, because I've never seen a market that behaves quite like this one does, with the fundamentals that are growing at the highest levels. And I guess what I would simply say is that when, like I said, the people running the money printers are buying gold, the central banks, you should pay attention. When the most sophisticated institutional traders in this country go from net sellers to net buyers, you better pay attention, and it's just beginning. And then when the U.S. government comes in and says silver's now a strategic mineral, that's just a floor been put underneath the price of silver by the U.S. government. And the massive imports coming into the United States, I would argue there's a floor under the price of gold. Ultimately, I think gold will be tied to a new system, a new monetary system. It will be definitely tied to one in the global south, and I think it will be tied to the treasury market here, a floor underneath the price of gold. So in my mind, this time is different. There's nothing wrong with taking a profit. It means you've won. But I would say that I think this, you'll look back at it. Look, let me put it this way. Goldman Sachs just came out and said if the market even thinks the Fed loses any bit of its independence, you'll see gold at 5,000 like that. Does anyone really believe the Fed is independent anymore? With Stephen Miran, the architect of the Mar-a-Lago Accord, now being put into the Fed, and the pressure that Trump is giving, and all of a sudden they talk about bending to 25% or 50% drop tomorrow. The Fed has lost its independence, which is nothing new, by the way. You go back through history, the Fed and the president have been intertwined more than you would think. They're telling you gold's going to go higher. And you look at a guy like Luke Gromen, who's as smart as anyone in this industry. He said, yeah, they're going to let gold go much higher, slowly, organically, before they revalue it. So let's look at it from a standpoint of price set, which is really, I think, part of the bigger picture to reach real price discovery. When you have a market where price is discovered, for example, in London and or in the United States, this is the problem, I think, in that the LBMA and to a degree also the COMEX have been setting prices for the entire world that have been massively rehypothecated.
Mm-hmm.
In other words, they sell the same paper over and over and over and over again, fearing or realizing that no one ever stands for delivery until they now are standing for delivery. And so when you see all of these exchanges being set up around the world, in Moscow, in St. Petersburg, in Shanghai, in Hong Kong, in Saudi Arabia, in Singapore, all around the world, these are exchanges where the people not only have been accumulating tremendous amounts, but they're the ones who understand it a lot better. These are mostly cash and carry markets. Ultimately, I could see a point where the LBMA is on the ropes. And I mean, I really do believe that the LBMA is on the ropes right now in many respects. I mean, there was just an article by a guy named Daniel Gali, senior commodity strategist at TD Securities, warning investors that silver appears to be entering the end game of the current cycle as demand, now driven by renewed investor interest, eats away at the last dregs of above ground supply.
Mm-hmm.
In an interview with Kitco News, Gali said the free floating stockpiles in the vaults of the London bullion market could run dry within 7 months if investment demand picks up. They actually only have about 1 day's worth of trading in silver right there. That's it. They have 140 million ounces of silver in London, yet they're trading over 600 million ounces a day. They have 1 to 2 billion in paper claims, ounces, 1 to 2 billion ounces of paper claims standing against 140 million ounces of silver. All of that metal has come back to the United States, and we were supposed to believe that it was under the auspice of tariffs. No, I said from day one, this has nothing to do with tariffs. They're reshoring it. The LBMA is on the ropes right now. And in other words, price discovery has been a function of suppression by the West. I think there will come a point a few years from now where the price setting is done in the East. And the COMEX and the LBMA are rendered not the primary price setting mechanisms of the world. You could see a combination of both pushing gold and silver substantially higher. And if gold is pegged to a new system, which I believe it will, whether it be treasury market here or backing a new settlement system in China, and the BRICS nations, there's a floor underneath that too. And so, yeah, I mean, I think it's both, really, and maybe equally.
If the current stresses in the silver market continue to escalate, the long-term effect could be a sharp revaluation of prices as physical demand collides with shrinking available supply. A sustained short squeeze, paired with thin inventories backing massive paper claims, would increase the risk of delivery failures and force prices higher as market participants scramble for what little silver is accessible. With governments and corporations treating the metal as a strategic resource, the creation of an effective price floor ensures that silver is unlikely to retreat to past lows, instead building a higher base for future growth. As industrial and technological needs expand, and as global powers compete to secure stockpiles, silver's dual role as both a monetary asset and an industrial necessity could drive a prolonged bull cycle. In such a scenario, silver prices would likely not only rise sharply, but also remain elevated, reinforcing the metal's importance as both a hedge against financial instability and a vital component of the modern economy. How do you anticipate the price trends of gold and silver evolving in the near term? Share your thoughts on experts' analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.